Hello, everyone, and welcome to another one of our weekly investment manager videos. Thanks very much once again for tuning in. To be perfectly frank, for the past 25 years, investors have not had to give any consideration at all to the effects that inflation has had on their portfolios. Yet all that may be changing with the reopening of the global economy post-COVID. How important is this, and what should investors be considering? Well, today I've had the huge pleasure of asking these questions and more to Adam Skerry, manager of the Aberdeen Standard Global Inflation Linked Bond Fund. But first, before we get into content, once again, if you are enjoying what we do, it would be wonderful if you could subscribe to the channel. It really does assist us in delivering our financial planning and investment content every week and sending that out to a wider audience. So, onto the content. Many thanks for coming onto the channel once again, Adam. Kicking it off, there's many issues facing market participants today, including rising bond yields, equity style rotations. How important is inflation to these decisions?
Yeah, thanks, Andrew. Good to be back again. I think you've been quite kind in saying 25 years. I'd say it's more like 40 years that we've not had to worry about inflation for. So since the late 70s and early 80s. Mm-hmm. So really the last 30, 40 years or so has been encapsulated by this idea of the great moderation, where we've been in this world of low interest rates, relatively low inflation, growth kind of trending downwards in its entirety. But what we've seen in the last 12 to 18 months particularly is this kind of reinvigoration of the reflation theme, of the emergence of fiscal policies, monetary policies, demographic arguments, geopolitics, starting to turn the tide slightly. So that's been accelerated by the COVID crisis. So obviously we've seen unprecedented levels of fiscal policy thrown at the problems that we've been facing. So outside of wartime, these numbers are just off the charts. Yeah. And as I say, running that alongside monetary policy that is extremely loose and continues to kind of be very, very accommodative, we're looking at a potentially a paradigm shift where inflation is something that's back on the agenda. And that's really been encapsulated in the last 12 months, particularly as we've gone through the recovery phase. Once the vaccines have been rolled out and the medical side of things has thankfully become more reassuring, people are looking at this and saying, okay, well, is this a persistent theme that we should now be considering? Is this something that we're going to have to become accustomed to? Are the kind of fiscal rules effectively changing? That are governments now happier to run deficits? Are they happy to take the lead in terms of investment, in terms of spending, to try and drag the economy forwards? Mm-hmm. And I think it's been really interesting, even in the first quarter of this year, that we've seen, rather than just emergency policy settings, we've actually seen a fiscal response that looks like it's more long-term. So when we look at Joe Biden's kind of infrastructure plans, for example, that are laid out for the next 8 years, coincides with the political cycle somewhat, but we won't go into that now. But, there's this kind of longer term planning now that isn't just saying, okay, well, we need to have very short term fiscal responses. We need to have furlough type schemes. We need to have, CARES Act in the US. These are actually now kind of trends that we're looking at and saying, okay, well, perhaps we can have inflation coming back for a more protracted amount of time than perhaps we've thought about previously. Because when we think about the pre-COVID kind of discussions that were in the market, it was much more around secular stagnation. It was around Japanification. Yeah. Are we looking at a world of low numbers pretty much forever? But I think now, as investors, and certainly the conversations that we're having are with a much broader base of investors coming to us and saying, okay, we haven't really had to consider inflation for, as you say, almost generations. Yeah. So now probably is the time to integrate some of that into portfolios. And the way that we've tried to kind of encapsulate that is saying that the tail risks have got bigger. Mm-hmm. So whereas before you were looking at a fairly narrow set of scenarios that involve lower growth, lower inflation, now we're saying that the potential is that, well, you might take the more pessimistic view and say, well, the scarring from COVID, the long-term effects of this are going to be with us for some time. So therefore, growth and inflation are going to be suppressed for longer. Yeah. Or on the other side of that, the other tail risk is that inflation really does start to pick up, and you've got a set of scenarios there where you want some inflation protection in your portfolios.
Yeah. Central banks seem to be key in a lot of these discussions, and from my perspective, the guidance that I see from them is that they're very confident in keeping a lid on inflation. Is this complacency?
It could well be. I mean, the response of central banks within developed markets has been fairly concerted in terms of they've seen as inflation as a price worth paying in the near term for the longer term recovery. So they're very unlikely to nip this recovery in the bud by hiking rates or taking away the monetary punch bowl too early. So they're aware that in the coming months, and depending on which central bank we're looking at, but the US is a good example, that in the next 3 to 4 months we're going to see inflation prints that are going to look quite spiky, because compared to 12 months ago when we're in the depths of the crisis, obviously everything was, well, most things were closed, you were zero on a lot of these prices, so therefore the bounce back that you're getting is going to be quite volatile in the next few months. But looking beyond that and looking at the second half of this year in the US and in the UK, you start to look at central banks and their kind of tolerance for above target inflation. Now, they've not really had to deal with inflation, as you just mentioned, for decades. And there could be the chance of that complacency coming in, because even when we look back at periods when we've seen inflation spiking higher, so for example, in 2011, we saw CPI in the UK running around about 5%. But that was met head on with austerity. We had the impending Eurozone crisis ahead of us. That was all boiling away. And so that put a lid on how much inflation could remain within the system. Whereas now we're almost at the other end of the spectrum. You've got governments that are, almost pump priming things in terms of fiscal policy. You've got geopolitical tensions that could potentially start to shrink that globalization theme that we've become accustomed to. China, we're a number of years down the line further, where the seemingly bottomless pit of labour force availability is now more suppressed. So you're starting to see the inflation pressures and the wage pressures in China starting to pick up. So there isn't that kind of degree of slack in the economy that perhaps we've been used to before. So all those things considered, you do start to think, well, if we do start to see inflation start to persist for a while, how tolerant are these central banks going to be? And we still think that it's likely they stay on the dovish side of the argument for now. But I think there is a concern within the market that this could run away slightly more than they're anticipating, because basically we've got central banks that have never had to deal with an inflation problem. Yep. For the last 30, 40 years, generations ago, we were back in the kind of late 70s when Volcker had to come in and put this huge suppressant on the kind of boom bust economics that we've become accustomed to. So, I'm sure they're mindful of that. But, looking at how the precedent that was set, 40 years ago, they'll want to avoid that kind of scenario again. But I just think that, as I say, the depth of the hit that growth has taken and the potential size of unemployment, because we've put a fairly resolute sticking plaster over unemployment for now. But if we have got longer term scarring, if we don't get a labour force that comes back on tap very quickly, if companies reopen but only look to be at 50, 60, 70% of productive capacity, they're not going to take on as many workers. So we might get, a kind of headwind to wages for longer than we're anticipating. But conversely, if things do open up, everyone goes out, spends, companies start investing again, wages start picking up, this thing can run hot for some time. So I would say there is a degree of complacency. But I think once we start to see the hard data, and effectively nobody knows what the long-term scarring is. Nobody knows what the kind of, medium to longer term outlook actually is, and what the composition of these economies is going to look like. But I think for the time being, the central banks see it as that price worth paying, the inflation running hot. If it covers, the other areas of the economy, it means that growth and employment can improve, then they'll see that as, something that they potentially can control later. Because they've got a heck of a lot of ammunition left. They've, and so with everyone effectively at the zero bound, there's a lot of rate hikes you can put in quite quickly. But yeah, their actual appetite and their desire to run economies hot for a while is yet to be seen.
Yeah. Taking all that into consideration and moving on to your own fund, the Aberdeen Standard Global Inflation Linked Bond Fund, how active have you been over recent months, obviously, where we're starting to see these quite significant changes coming through, and where you're currently positioned towards?
Yeah. Just going back a little bit longer. So 2020, we did play the reflation thing. So we did have long break-even positions, particularly in the US and Australia. Ran those for the majority of last year. That was alongside an overweight duration position. So we were long of real yields. So inflation-linked bonds we were overweight of. Effectively on the argument that central banks were going to keep real yields anchored. The policies that they were implementing predominantly through quantitative easing meant that real yields were effectively pinned across the curve. Right. Now, where we've had to change our view slightly this year is that is not necessarily the case, that as break-evens widened last year and have continued to widen for the first part of this year to a lesser degree, we've had to look at the real yield and say, okay, well, there is some upward pull in certain markets. So we've taken the fund back to neutral in terms of duration. But what we've tried to do is say that all recoveries aren't going to be built equal. So while the global reflation theme is by its definition global, and that we think that there will be inflationary forces at play in various markets, they're not going to be running concurrently. We're going to see central banks start to move slightly differently. We're going to see governments react to things slightly differently. So that and markets start to react slightly differently. So we think that's going to create more cross-market opportunities. So what we've looked to do is, for example, we've closed out the long in US inflation because we think that's relatively fully priced. So with front-end break-evens around kind of 2.6% in the 5-year part of the curve, we think, okay, well, on an asymmetric basis, it's not really skewed one way or the other. Whereas when we look at somewhere like Australia, where the 10-year break-even inflation rate is around 2%, we think there's more upside potential there. So we're looking at a relative value play between those two. Similarly, in duration terms, I mean, we're underweight US tips at the moment. We think that the Fed potentially could let things run hot, so therefore US real yields could start to drift a little bit higher. And as they start to step back very, very tentatively and talk about taper of asset purchases, then there is a slight upward bias in US yields. But on the flip side of that, we're happy to be longer of European yields and Canadian yields in particular, where we think the central banks there are going to be a little bit more dovish for longer. So we're looking to still play that reflation theme overall, but we're a little bit more selective in terms of the actual exposures that we have within the portfolio.
Yeah, sounds to me that it's not going to be a rising tide lifts all boat. You need to be active. You need to be taking active decisions, be it in terms of allocation or individual securities, not just with inflation linked, right across the board. Adam, once again, it's been an absolute pleasure to talk to you. You take care, and I'm sure we will catch up soon.
Thanks very much.